You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
You say gold is one of the most interesting things happening right now.
Yeah, it definitely is. I mean, frankly, though, most people aren't paying attention to it, especially in the United States. Most people are really obsessed with the U.S. stock market, and we had a big drop in August that happened very quickly and bounced back up. But I think it's still a bear market. But regardless, everyone is always focused. That's all they talk about on television. Is the Dow is up or down in a single day. And interestingly enough, on Ameritrade, they have information about which stocks American investors are doing the most buying and selling in. They analyze about 6 million brokerage accounts and tell you this every month. And it's Facebook, not Facebook, Netflix, and some technology stocks. Facebook is often on the list, but for the past 2 months, it's been Netflix. It's been the most actively bought stock, and then a couple other technology stocks. Interesting enough, GoPro is one of them. Don't ask me about that. But the reason I bring this up before saying anything about gold is this is what everyone is really focused on, is the U.S. stock market and these kind of momentum stocks, which frankly are very dangerous at this point. From 2012 to really this time last year, they went up without ever correcting more than 10%. The stock market as a whole never fell more than 10%. So these stocks did really great during that time frame, but they topped out in July, and a lot of the stocks actually have gotten hit hard. Biotech stocks, for example, were a big momentum sector that topped out, and some of the stocks have fallen 20% since July, some of them even more than that. And again, the point of all this is what everyone is obsessed and watching. And while everyone has their eye on these things, gold and the mining stocks have really done well and appear to me to be breaking out or on the verge of breaking out into a new bull market. Since the July top in the NASDAQ, gold, silver, and the mining stocks have performed better than the U.S. stock market averages. If you like technical analysis and charts, anyone can see this for themselves by looking at the relative strength ratio of gold versus S&P 500, comparing the price action in gold and the S&P 500 by dividing them and making a ratio. You can plot it out. And that's been rising since July. And whenever the U.S. stock market begins a new bear market, which is what I think is happening, you get a rise in volatility in the market itself. As you see lots of big swings up and down and really, surprise everyone, make people watch the market more. But when this happens, there's always a few select sectors or asset classes which don't move with the market and actually start to perform better than the market. And then they break away and break out of bases. Often they've already been in bear markets in the past couple of years, and then they just go into new bull markets. I've seen this in the 2000 bear market when the technology stocks all blew up in March and April. There's a big shift that occurred into tobacco stocks and utility stocks in REITs that lasted for years. Those sectors went up throughout that entire bear market. And what happened was in the year 2000, no one talked about them or paid attention to them because everyone was still obsessed with the tech stocks. Now in 2007, there was a big money shift into the U.S. bond market that started in the summer of that year, and bonds really took off and did incredible in the fall. But once again, no one really paid any attention to it. So we're really seeing the same exact thing occur right now, whereas the U.S. stock market is becoming more volatile. It's what it does in the beginning of a bear market. And yet, the real opportunities to actually buy something that's going to go up in a sustainable manner are being ignored. The market has rallied sharply over the past 10 days or so, and people want to buy into these stocks that they see on the television set, thinking that the market is simply going to go to new highs and it's 2012 again, but it isn't. And the things that are going to go up are really invisible. So I think gold and gold mining stocks, really commodities in general, are making a transition out of a stage one basing phase and into a new bull market. Now, what a stage one basing phase is, it's a period of sideways action that follows the bear market. So the price of gold topped out in 2012, and the mining stocks did too, and they fell really until last year, last October, is kind of gold started to really bottom out. Now in July, the mining stocks made one final low. They actually fell almost 10% the very day that the NASDAQ peaked out on July the 20th. But, you know, if you look at gold, you can see clearly that it has support now around 1080, a long-term support. That was the final low made in July. And resistance is the 200-day moving average at 1176. And today, we're right under 1150. Now, 1176 is a really important number because, again, it's where the 200-day moving average is. But it's stage one basing phases. It's a breakout through that level that marks the start of a new bull market. And in a bear market, that 200-day moving average tends to act as resistance. So in the U.S. stock market, it's now below that level. It fell below it in August. So to put it to you another way, the U.S. stock market really started a bear market in August when the averages in S&P 500 and NASDAQ fell below the 200-day moving average. And it took about 3 days after that drop, or after the close below that moving average. 3 days later is when we had that big flash crash. So it was a violent drop in the space of a couple days. Now, with gold, it's in the opposite situation that the stock market was in August. Gold is right below the 200-day moving average. It has short-term resistance at 1150, 1150. If it breaks that, it's pretty much, I think, a short bet it's going to go to the 200-day moving average. Now, the fall below the 200-day moving average for the S&P 500 sparked some selling panic for a couple days. Now, a close above the 200-day moving average for gold will do the exact opposite. It will spark buying. So this is an exciting moment where the gold is on the verge of busting through those levels, and if it can just do that over the next couple of weeks, we're going to see gold start a new bull market. That's not a rally for a couple of weeks or even a couple months, which is, you know, the U.S. stock market, we were bouncing, I think, in a rally that started really 2 weeks ago. The bear market rallies lasted only a couple weeks, and then you top out and end, and you go lower. So that's where we are. Maybe the market can hang in there for another week or two, but, you know, it's just a short-lived rally. Where if gold, you think about what gold has done since 2012, we've seen many, many rallies in gold that only lasted a couple weeks. You know, they all failed. Why? Because gold was in a bear market, and so were the mining stocks. However, we break out now of the 200-day moving average, 1176, 75, 76, and this is a rally that's not going to just last a couple weeks, but a couple years. Gold's in the position that the U.S. stock market was in March 2009, or gold itself was in October 2008, and in the fall of 2000, in a position to begin a new bull market that will last a very long time. So it's an invisible trend, you know, if no one is talking about this. We're talking about it on your show, but no one will hear it on the television set or hardly anywhere else because it's invisible. But hopefully the people listening will run to their computers and pull up the charts and see exactly what I'm talking about with their own eyes.
That's right. We're running the theater of imagination right now. We'll have more with Mike Swanson right after the break.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson from WallStreetWindow.com. Mike, you speak on your website about the bubbleheads. Can you maybe explain who they are and what they're up to?
Well, it sounds like a derogatory term, but it isn't. It isn't. A bubblehead is, I believe, what I say a bubblehead is somebody who believes that stock market valuations don't matter, earnings don't matter, and fundamentals don't matter when it comes to the stock market. All that matters is the belief that the stock market is going to continue to go up. Now, in a bull market, those ideas can make you money. So people in about 2013, there's a commentator named Robert Shiller. He popularized an indicator called a cyclically adjusted PE ratio to tell you what the valuation of the stock market is. Well, in 2013, his indicator said the stock market was overvalued. And I would see people in the financial media who don't want to hear that say, well, he's wrong, or it doesn't make any difference. Valuations don't matter. The market can go up. It went up in 1999, so it can go up again. And they would argue that the Fed has interest rates at zero, and it doesn't make any difference. And this year, the second quarter earnings shrank. And this coming quarter, the earnings reports are set to show that companies the earnings have shrank again about 3.3%. And bull people say that those earnings don't matter. Earnings doesn't matter. All that matters is the stock market is going to go up in their view. So that's a bubblehead. They don't really, use fundamental analysis or invest based on really anything except a belief that the stock market has to go up, and that's just how they invest. They don't do any research, or they just have a belief system. The thing is, at the end of a bull market, that can work for a period of time. So in 1999, internet stocks went up, and people who got in on that made money if they got out. In 2012, and in 2013, as I mentioned, the stock market, of course, went up. Last year it went up. This year, not so much. But the problem is the bubblehead type person who makes money at the end of a bull market almost never adjusts and gets out, and then they end up losing everything they made, or even worse. So to me, once the bear market's here, which I think we were at, it starts for me to become a derogatory type term, because I think people who are investing like that or advocating people do that are really reckless, and they're going to hurt themselves or hurt other people. And it's not necessary to do that to make money. I mean, the smart thing to do in the long run is to diversify in different markets, different asset classes, and the bubblehead type person tends to just be in one market and become all wrapped up and obsessed with it. And even to an extreme, they can just be in one sector of a market, or just own 5 stocks that they just are almost delusional about, and there's no stock really in history that's gone up forever. If you look at the Dow, the Dow stocks, the Dow 30, the components in that Dow 30 have changed from time to time. Stocks have been taken out. I think something like half the Dow 30 in 1900 don't even exist anymore. So, it's just the idea that you can just buy one thing and that's all you need to do is really mythical. And when it comes to prudent investing, you don't need to have all your money in the U.S. stock market when there's other opportunities. Doesn't necessarily mean don't have any money in it. So now I think you should certainly have less than before. But regardless, it's just prudent real investing is looking for markets and stocks at super cheap valuation and buying them when they're super cheap and turning up, because then you have an opportunity to make huge returns over a couple of years, and then keep looking for these opportunities. Like say gold right now, I think has a good chance to break out and go up for several years. Well, that doesn't say put all your money in gold and mining stock and never sell them, and just put them in there for 50 years or something. The average bull market actually lasts 3 to 5 years. The best thing to do is put some money in there I don't have 100% of my money in gold and mining stocks, but I do have a good percentage of it in there now. But I am going to continue to look for other markets and other opportunities that I think gold is in now. Let's say gold goes up for 2 or 3 years and we can find some other market that looks like it's going to end a bear market or begin a new bull market. Maybe the U.S. stock market will be in that sort of position, or some other foreign market, or who knows. So we all, to really, this is a long-term game, investing. If you want to make money at it, it's not just throw your money at one thing and get all delusional about it, but get in something and always be looking for the next big opportunity. It's like John Templeton. He made a lot of money by investing in Japan in the mid-1970s, and then he started investing in the U.S. stock market. He wasn't in the U.S. stock market in the mid-70s, but in the early 80s, he shifted lots of money there because he thought it was a great opportunity. But then around 2000, in 1999, he greatly reduced his holdings in the U.S. stock market because it was a bubble. Now, he's not alive today, but if anyone wants to use his type of philosophy, he likes to invest when things are beaten up, destroyed, no one else is interested in them, and they're really invisible to everyone else. And boy, if the mining stocks don't fit that category right now, I don't know what else does in the stock market.
Mike, thanks a lot for chatting with us.
Thank you. It's always great to talk with you.
My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.